Hello, good evening everyone. Welcome to all of you for today's session. Students, just let me know whether you people can hear me well. Can you hear me well? Tell me please. Yes. Okay, so just give me 2 minutes more. Just 2 minutes. Okay. I'm just waiting for others to join. Some of them you are struggling actually. They are doing this online class first time. So just 2 minutes more. Okay, then I'll start the lecture. Students, have you received the notes? Everyone? Have you found the notes volume 1? Handout volume 1? Good. All right. Tell me one thing. How many of you have attempted the paper in this last September? How many of you have attempted the paper in this last September? Yes. You can send me a direct message. Means that if you don't want to disclose public, the direct message, please. One person only. Others have not attempted in September. Tell me frankly, please. Okay. How many of you are going to attempt first time in December? Now, this is answer this question, please. Answer this question, please. Very good. Very good. Right. So I will have an idea that this mix in the class, mix of student in the class. Right. So students, financial management. One thing should be clear from today. We will be talking about, of course, in the upcoming all sessions about it, the paper. We'll be talking about it. So financial management, okay, this is my introduction, etc. So there are basically 5 days available. Day 1 today, and the next 4, you know, that Wednesdays, 9th, and you know that yes, 9th, 16th, then 23rd and 30th, right? And then these 4 days will be over here. 1, 2, 3, sorry, 3 and 4. And then is the day 5, which is the 3rd December. It is Saturday. It is Saturday. And on Saturday, I'm telling you in advance, we will be having, on Saturday, it will be 6 hours class. It will be 6 hours class. These are 4 hours, 4 hours, 4 hours, 4 hours. And if needed, I may extend 7 to 8 hours. Now I'm telling you in advance how these 6 hours we will be studying. What will be the timing? What I have in my mind when I was planning the crash course timetable, in my mind, the timing of Saturday is, that is 8 to 3. Means 3 means 15 hours. Will that be okay for you people? Saturday? I'm telling you in advance before I proceed with the crash course. Will that be good for you people? Tell me, please. Yes. All right. Now, so let us proceed. So today we will be starting with investment appraisal. Investment appraisal. So investment appraisal, before we start, there are some important links. computer-based exam and CBE, past exam paper, CBE, okay? And some sample specimen exam platform, link is here, past exam and platform is here. Now, section A, section A. So section A, the point is 15 MCQ, multiple choice question, objective test questions, 30 marks. Yes, multiple task question. That's a scenario followed by 5 questions. So 3 scenarios, 30 marks. And constructive response question, 40 marks. 40 marks. So in this way, it is total 100-mark paper in front of you people. The point in FM, why students fail in FM? Before we proceed, we will talk about that why students fail in FM. A big question. Yes, a question is here. Students, the biggest reason are two biggest reasons. One is they lack thorough knowledge. Thorough, conceptual knowledge of subject. Means they have not prepared the subject well. Theoretical, especially theoretical aspects. Especially theoretical aspects, they have not prepared. So when they have not prepared, so, and this is the point with FM. Students majority think FM is only calculations based. Calculation based you prepare, that's good. But remember, there will be sufficient marks. Out of 100 marks, if I pick from past paper, you will be having around 40 marks minimum on theory. Theory means in all 3 sections, there are questions in which theoretical points are there. Section C, section B, section A, where you have not to do any calculation. So around 40 mark paper means that is conceptual clarity is required from the students. And the second is lack of practice. Because practice makes you perfect. No matter how detailed knowledge you have, although detailed knowledge is base, it is base, foundation. But if you do not do sufficient practice questions, remember you will be suffering in exam. You will take more time to understand that, when you do not practice, lack of practice, what happens because of that? The first thing is you take more time, reading time for question, because you have not done that question, reading time. You know that, you spend more time. Second, you misunderstood. Question and choices available. You misunderstood. You are unable to understand what are the requirements and how you have to draft the answer. The problem is there. And the third matter is when you miss, and the third case. So because of which it causes time management issue. It causes incorrect answers. Yes, incorrect answers. And ultimately, you lack the knowledge how marks are awarded. So then you spend time, waste time on unnecessary things, unnecessary discussions, calculations in exam. Because you don't know how the marks are awarded. Because you have not done any practice. So from the day one, I will be sharing with you people one important thing. You see here, let me open it here. Just 1 minute, please. This is ACC website. Come to financial management tab. 2-3 things which are important to be focused here. The one is, and students don't know, unfortunately, for these things will help you for each subject preparation. One is exam techniques. Read the mind of the marker. Read the mind of the marker. I will send its link to you in the WhatsApp group. Just a minute. WhatsApp group of class. Read the mind of the marker. How to attempt discursive requirement, discussion. Very important. Objective questions for sessions. Yes. So especially the first 2 or 3, all 3, you should go through these articles by the examiner. And to get understanding that, you see here. So I have shared its link in the WhatsApp group of class. The second point is, let me go back to the financial management. Yes. That is examiner report. And the latest 2 examiner reports. Latest 2 examiner reports. These will help you a lot what examiner thinks. Let me open this one. I will share its link as well to you. Yes, March, June, this is the latest available examiner report. I will be sharing its links too in the WhatsApp group of the class. Examiner reports. Now, so the point is, if we go the comments, examiner comments, So examiner is saying the points. First of all, he is discussing the questions. Now, how the answer, what is the answer? He's discussing that. And the examiner is discussing the mistakes by the students as well. What are the mistakes done by the student? You see here, many candidates did not adjust the earning per share. General comments, very important comments, that they should read the question carefully. Follow the instruction how to answer the question. For example, if a question asks the candidate to select two correct statements, then marks means which two are the correct in the question, and you select only one, there will be no mark for that. No mark if you pick a partial item. Yes. Now, sorry, just a minute, where it has gone. Yes, here it was. No mark. And then the second point, in addition, when answering a number entry question, for example, examiner say answer your question in million. And in the million, you see here, so the million, a candidate puts a full answer. For example, 13 million like with zeros in the box rather than 13. You will not get any mark. So you have to check the format what they are saying. Because answer in the wrong format will not be accepted. Remember that. In the wrong format, answer will not be. Although you say you have done calculation correct, but if you're putting the wrong format, you will not get marks. Very important. And sometimes there is no specified format. Answer may be given as integer or to 1 or 2 decimal points. Then sometimes they say give answer up to 2 decimal points. Means where it is specific, your answer should follow the given instructions. Remember that. It should be very much clear. Now, so they say that section B tests knowledge in more detail. Sorry, it is not. Just a minute, please. Let me open it here. Then I can comment on it as well. Yes. Just one second, please. It's not being shifted. Anyways, come here. Okay. So you see here, this area requires in-depth knowledge. Section B, more detailed knowledge, in-depth. Means the questions will be a scenario, full-fledged scenario, and then you have to pick the answers. So examiner has discussed the common errors as well. You see here, it has been discussed. So using days as a basis, okay, you see here. So reading the requirements properly. So commentary will be here. Okay, right. So after each question, they have Discuss. Yes. Section C. So they have discussed the point. What are the issues with the student? What are the issues with the students? So what they omitted, what the errors they made. Yes. In general terms, candidate always need to show all working, which can be shown in a separate working or within a cell, means formula of the calculation. How you have calculated certain answer. It is not acceptable for a cell to simply contain a typed in number. I will explain when I will be solving the question. Yes. So whatever you do, you should explain now. So IRR, they have told what are the mistakes by the students. So I have just gone through with this, that what are the students, what are the requirements of examiner? What does examiner say? Further, when we will be solving this past paper, then we will be talking about it, right? Now, so the key message from this question overall are, read the requirements carefully. Look at the marks. And when in the, this is about the section C, where the examiner says discuss, you will not write the bullet points. Bullet points won't get you any marks. Remember, I'm repeating my words. Bullet points won't get you any marks. You have to write answer in the discussion style. Yes, in the paragraphic form. Now, so this is very important to learn. Students normally, for example, advantages and disadvantages of a certain item, of a certain investment appraisal technique. So in your notes, in your exam kits, normally advantages and disadvantages, they are given in the bullet points, in the notes, everywhere. In exam, you have not to write like that. In exam, you have to write in the discussion form. If you write bullet format answer, you will not be granted any mark. So this is just mistakes over. And I will be talking about these things again and again, again and again, moving through the crash course. Now come here, come back to the crash course notes. So investment appraisal, how it is done, why it is done, importance. These are the theoretical topics. And in crash course, of course, I cannot cover everything. My focus in the crash course is some key topics and practice. And while doing, and I have shared with you the exam kit as well, which we'll be using. So in the investment appraisal topic, we know that investment appraisal techniques in your syllabus, 1, 2, 3, 4, 5. These are called discounting techniques. These are called non-discounting techniques. These first two are called non-discounting techniques. Non-discounting. Discounting means where present value is calculated. Values are calculated. And in the non-discounting technique, we don't calculate any present value. We don't calculate any present value. Now, so accounting rate of return. What is accounting rate of return? The first one. Accounting rate of return is the technique which is profits based. The only technique which is profits based. Yes. Techniques. ARR. ROS, it is also called ROS, return on capital employed. Another name. Students, basically, we are calculating average return of a project. The average return of a project. So ARR is equal to average annual profit divided by average investment into 100. Where average investment is equal to initial investment plus scrap value divided by 2. If ARR of a project is greater than target ARR of company, we say accept the project, otherwise reject. Now ARR has some drawbacks. Drawbacks of ARR. What are the drawbacks? I will discuss a few drawbacks in quickly. Students, it is profits based, which are subject to manipulation. Profits based. Second, profit based technique. The second point is regarding ARR is it is accounting rate of return. Second drawback, that it ignores the time value of money. No discounting. All the profits of the future are considered to be the same year profits. And the third drawback is it is a relative measure. Means relative measure means give answer in percentage. For example, ARR for project is 50%. Now 50% ARR, what does it mean? What is the amount of return? That is not indicated. It is just a relative measure. It is not indicating what exactly the return is. So this is accounting rate of return. Now payback. Payback. The time period required to recover the initial investment. Every business is interested in it. Remember, only payback is profits based. Only ARR is profits based. All other techniques are cash flows based. Now, what is the difference between cash flows and profits? What is the linkage? What is the difference? Now, can anyone out of you tell me? Anyone out of you? Okay, let me tell. Students, when we calculate profits, so we deduct non-cash expenses. We deduct expenses like depreciation, provisions, okay, some estimations, non-cash expenses. They are deducted, then we reach profit. So it means while cash flow, so we will add back those non-cash expenses. Add back. Then we get cash flows. We add back non-cash expenses. Then we get this. Now, next. So this is the difference. This equation should be clear. So that's what. So that's I told you that profits are subject to manipulation. Why? Non-cash expense increase, decrease, profits can be manipulated. Cash flows have advantage; they cannot be manipulated. So payback period. So every investor is concerned that when my investment will be recovered. Initial investment, which I am investing in a business, how much time it will take to recover my initial investment? How much time it will take? Now, next point. So you see here, this is the initial investment. These are the cash flows. How to calculate payback? So cash flows are given. And then what we do, cumulative cash flow, we calculate. And in the final year, so 2-year complete. Now we need this. In the next year, these are the cash flows. Multiply by 12. So these is the cash flow payback period. Next. Let us proceed further. So payback, advantages and disadvantages. Students, payback has some disadvantages. The one is, does not consider time value of money. It is not a measure of return. Payback is not a measure of return. Yes, that how much return they're getting. It is not the point here. So it is just only in how much time my investment will be recovered. So the point is, yeah, this is a very valid point. For example, 2 projects, A or B projects. 2 projects. Year 1, 2, 3. Investment is, for example, in its 2 million, 2 million. Investments. So 4, 5. For example, it is giving 0.7 million, 0.8 million, 0.5 million, 0.2 million, 0.3 million. It is giving 0.1 million, 0.1 million, it is giving 1 million. Yes, 1 million. This is investment and this is return, cash flows. 0.2 million, 0.1 million, 0.1 million. If we see project B has 2-year payback period, and this has 3-year payback. Its payback is 3 years. Payback period. Now, as per payback period method, this project should be selected as per payback period. But you see here, so it is ignoring cash flows, what they are getting after payback. What they are getting after payback, it is ignoring. Here 0.5 million, here 0.4 million. So it is ignoring what is happening. So it does not consider full life of the project. It ignores the cash flows occurring after the payback period. Okay. Now, and One more thing I will write here, which is missed here. It encouraged the investment payback period. Investment in short-term projects. Short-term. Invest in short-term. Those projects which are short-term. So business may lose long-term focus, long-term growth. There might be certain projects which are long-term important. Now, next. The next point is, the next point is, okay, now, just 1 minute, please. The next point is NPV, net present value, NPV of the project. What is NPV? NPV of the project is that it tells impact of a project on shareholders' wealth. NPV tells, this method tells impact of a project on shareholders' wealth. That if we undertake a project, what will happen to the shareholders' wealth? If we leave a project, what will happen to the shareholders' wealth? Yes. NPV, net present value. So NPV of a project is calculated. We calculate this present value of all cash flows and all cash flows, negative, positive. And then sum we calculate. The NPV of a project discounted at cost of capital. If it is positive, then accept the project. Now, positive NPV. Actually, what we do, we say that if NPV is positive, accept the project. NPV is positive. We say accept the project. Why? Actually, positive NPV means that the project is repaying all of its cost. Positive means project is repaying all of its costs and initial investment. Yet there is additional cash generated by the project. Yet there is additional funds generated by the project. This is called positive NPV. NPV is positive. Now, if NPV is a negative, it means that a project is unable to pay its own costs, own expenses, own initial investment. Project is unable to pay. Yes. So we say that reject the project. Some of the students are logged in from more than one device. Please log out from one. Yes, please log out from one. Yes. Now, The next point, so I'm requesting, please log out from one. Yes, thank you. Now, the next point is, so IRR, so NPV, advantages and disadvantages. So NPV with positive project with positive NPV increase the shareholder wealth, right? That means consider time value of money. Yeah, if discount rate is changed through the life of the project, it can be adjusted in the NPV. It considers the full life of the project. And it is missed here. Yeah, it is. Yes, here it is. This is explanation. It is an absolute measure. NPV is an absolute measure, means it tells the exact impact on shareholders' wealth. NPV is an absolute measure. It tells the exact impact on shareholders' wealth. Yes. How much wealth will be increased due to a project? How much will be decreased? Now, next. So the next are drawbacks. A discount rate calculation is difficult. Managers do not understand normally. Cash flows are estimates. Cash flows are estimates. We in the NPV, we assume that cash flow occur at the start or at the end of the period. This is assumption. While cash flow occurs throughout the year, mid-year as well, which is not assumed by NPV method. And speed of repayment of investment is not highlighted. How speedily, which is by the payback period. Okay, so it is okay now. IRR. Students, IRR. Remember in the section C of your paper, exam paper, all these calculations have to be done through formulas. All calculations will be done through spreadsheet formulas. Yes. But the point is, section A and B, there becomes a problem. Their answers. For that purpose, we need to know that how to calculate, how to do this calculation on calculator too. Remember, the problem arises in section A and B. The problem arises there. Because there we need to calculate it. There is no spreadsheet available. A and B. Now, next point. So IRR is the return offered by the project. Percentage, it is in the percentage. Return. Total rate of return offered by the project based on cash flows and time value of money. So IRR formula. A student has asked a question. Can you please send question to ask to all so that everyone can see the question? Then I will answer. Send to all, please. your question, copy and paste there. Do we lose mark if we don't use spreadsheet formula in section C? The answer is yes and no both. You must be thinking how. Remember, examiner, if you calculate the answer on calculator and put answer in the spreadsheet, final answer, there will be no mark for you because you have not shown how you have reached that answer in the spreadsheet. You are not using spreadsheet formula, okay, no worries. But you have, if you are writing an answer in the section C, you need to show the calculation how you have reached this answer. You got my point. Examiner is saying that if you calculate everything on calculator and you simply put answer there, no, you will not get any mark in section C like that. I will go to the platform and I will be showing you what I'm saying. What do I mean? You can ask this question to me at that time again. I'll be able to better explain. Okay, when I will open the exam platform in front of you, right? Okay, dear. Now, so the next is discounted payback. Discounted payback considers the time value of money. Time value of money. So the time period in which initial investment is recovered in terms of present value is called a payback period. Cash flows, discount factor, present values, and cumulative cash flows are made on present value. So cumulative, 2-year complete, part of year 3. This is discounted payback. So discounted payback has covered one drawback of simple payback, that it considers the time value of money. It considers the time value of money. Now, everything else is the same. Students, only 2 to 3 adjustments we will do. Then I will shift to the exam platform and we will be doing the practice questions. Adjustment of taxation in the investment appraisal. Adjustment of taxation in the investment appraisal. The first adjustment is taxation. Just 1 second. Here is my pen. Just 1 second, please. Okay, found. Right. Okay, so adjustment of taxation. Students, 2 aspects are there. One aspect is impact on cost of capital. On cost of capital. And the second is impact on cash flows. So remember, use always post-tax cost of capital as discount rate unless examiner says ignore taxation. If they say ignore taxation, then pre-tax cost of that will be capital will be used. Now, timing of tax. Tax is paid in the same year or in arrear, whichever is specified in the exam we have to use. Now, now this is calculation of tax cash flows. 2 types of tax cash flows. One is tax payment on taxable cash flows. Sales minus costs. What are the taxable cash flows? Sales minus Cost, variable cost, fixed cost, admin cost, rent cost, fixed cost. Sales minus cost is equal to taxable cash flows. Sales minus cost. Then we pay tax on the tax rate. If it is in the same year payment. If it is in the arrear, so payment will be in the arrears. Yes. Now, the next is tax saving on capital allowance. Tax saving on capital allowance. Very important. So how it is calculated? Here it is. Example in front of you people. Initial investment is this. Capital allowance is 25% reducing balance basis. Useful life is 4. Tax rate is this. In arrears, scrap value. So what we do? We write written down value 2000 in the start of year 1. So capital allowance 500 on it. Now let me open this Excel sheet here and solve an example here. That will explain it better rather than writing in this way. Just a minute, please. Let me open Excel sheet. Yes, here we are. For example, initial invest. So we are discussing tax saving on capital allowance. Yes. So very important adjustment it is in the exam point of view. So for example, year 0, 1, 2, 3, 4. 4-year life, initial investment is, that is 3000. Scrap value is that is, for example, 200. Tax rate is 30% in arrears, and capital allowance can be claimed at 25% reducing balance basis. These are the points available now. So students, initial investment is here. Sorry, not here, here. So at the start of the year 1, this will be the written down value. What is the capital allowance? That is equal to this into 25%, reducing balance basis. What is the written down value? This minus this. Now, the next year, my mistake, just a minute. Yes, sorry. So it should be here, this into 25% and this minus this. Yes. Written down value. So capital allowance, this into 25%. So written down value is this minus this. So equal to this into 25%. Now, written down value is here. Now students, scrap value is this, last year. This minus scrap value. This will be the capital allowance. And tax saving on capital allowance. How to calculate? In arrears. So you see here, for this, tax saving will be in the next year, 30%. 30%, year 5. So you see here, I've simply applied the formula. Tax. So this is the cash flow which we needed. Tell me, student, is it clear or should I re-explain anything? Tell me frankly if you want me to re-explain anything. Tell me, please. Okay, good. Now, next, let me open notes here in front of you. Yes, so effect of taxation have been done. The next is effect of inflation. So again, effect of inflation. Inflation is of two types, general inflation and specific inflation. The general inflation is one, yes, which is which is general, average out inflation in the economy. This is called general inflation. What is the specific inflation? So inflation, I'm telling you, inflation is, one is called specific inflation. What is specific inflation? For example, we say wheat prices have increased by 10%. So 10% wheat inflation. Labor cost increased 5%. So 5% inflation on labor cost. General inflation is basically calculated by the central bank. It is also called CPI, Consumer Price Index. That is the inflation, average inflation in the economy. Okay, that is called. Now, so students, impact of inflation. The first is impact on cost of capital. Impact on cost of capital. Yes. Impact on cost of capital, the first thing. Yes. Now, there are two types of costs, real rate of return or real cost of capital. Then is a nominal or money cost of capital. Real cost of capital is one which is without the effect of inflation. Nominal or money cost of capital is which is with the effect of inflation. With the effect of, which includes the effect of inflation. So there is a Fisher's formula which tells the linkage between the both. Linkage between the both. The 1 plus M, M is money rate of return, real rate of return. And I is, remember, this need to be understood, where I is equal to general inflation in the economy. Yes, this is very important to understand because in exam it has been tested multiple times. In exam, examiner says calculate NPV through money approach or the real approach. Now, so money approach is that inflate all cash flows with specific inflation, each specific, and discount net cash flow with money cost of capital. Simple as that. Money or nominal cost of capital. Real approach. Now, there are the problem. It is the problem. If specific and general inflation is same, mean only one inflation rate for everything. There is only, in other words, there is only one inflation rate for all. Life is easy. Discount all net real cash. You need not to inflate any. Real cash flows with real cost of capital. But if they are different, now points have been tough. These are tough points. Convert all cash flows into nominal first. Then discount nominal cash flow using general inflation to get real cash flows. Yes. Then discount real cash flows with, you see, discount first of all them with the discount using general inflation. General inflation, you see. And then discount real cash flows with the real cost of capital. That's it. Now, so students, next is, so this is the NPV performer in front of you people. So it is a sales minus cost, tax, then tax saving on capital allowance, working capital, initial investment, discount factor, and NPV. Now let us go to the some section 3 type of questions. Section 3 type of questions. And then we will come back to it. Now, so Pink Company, March, June 19, real and nominal method, both are part of it. Pink Company, a benchmark question. So I have given to you people the past paper link here. Even this question is present in the exam kit as well. If you pick exam kit, you will find this question. Okay. So just a minute. Let me open the ACCA website. And the past papers are here. Past exam library, it is here, right? Past exam library. Let me give its link to you people as well. Yes, just a minute. I will share it to you with you in the WhatsApp group of class. You can open it here as well. I will be sharing in the class messenger as well. Yes, here we are. Yes, past exam papers. So March, June 19. This is the past paper. C section. Yes, pink company. Here it is. Everyone, please find this. Otherwise, I can send this past paper here as well. Let me send this past paper. Please open it and read this question, everyone. Calculate the nominal net present value of pink company's investment project. It is in front of you. You see here. Pink companies. Yes. Nominal. So then the real present value, NPV of investment, and comment on your finding, 4 marks. Now, discuss 4 ways to encourage managers to achieve stakeholder objective. Friend, my suggestion to you people, that when you are practicing your question for exam, leave pen and paper. Open your computer. I don't know how you prepare. How do you practice for exam? Use soft copies of the notes, of the question, Excel sheet, word processor, and do practice throughout the session now before exam, like the way you will be doing exam. The point is, the problem is, which I have come to know, majority students keep using pen and paper, which is not advisable now, because in exam you will not be using that, and you'll be feeling hassle over there. Now, so please open this question and read it well. Then I will be starting it. Now, so students, let us start it. So Pink Company is a large listed company on a stock exchange. In recent years, the board of Pink has been criticized for weak corporate governance, and two of the company's non-executive directors have just resigned. A recent story in the financial media has criticized the performance of Pink Company and claimed the company is failing to satisfy the objective of key stakeholders. Pink Company is appraising an investment project which it hopes to boost performance. The project will cost $20 million, payable in full at the start of the first year of operation. Start of first year means in year zero. The product life is expected to be 4 year. Forecast sales are, so this is sales, selling price, variable cost, fixed cost. Selling price and cost information are in current price terms. Before applying selling price inflation, this, variable cost inflation, this, fixed cost inflation is this. These are the specific inflations given. Pink Company pays 28.6% tax in being settled in the year in which it arises, means same year. The company can claim tax allowable depreciation on the full initial investment of 20 million on a 25% reducing balance basis. Just one thing coming to my mind, students. It's 1.5 hours since we started the lecture. If needed, tell me, can I extend class by 30 minutes or 1 hour? 2 days class. Can I extend 30 minutes or 1 hour? If needed. Because I want to do a lot of practice. And practice needs time, you know. 3 persons responded, 4. Okay, right. Okay, thank you. Okay, right, come here. The investment project is expected to have 0 scrap value at the end of year 4. Pink Company has a nominal after-tax cost of capital of this and a real cost of capital of this. General inflation is this. So the first part we will be doing first thing first. Now, so come here. Yes, it will be like this. So the question is, Pink Company. Pink Company. So students, sorry. Yeah. So sales, we need to calculate. Sales, variable cost, we need to calculate. And then, yes. So come here, we will be doing, first of all, working here. Year 1. So year 2, year 3, and year 4. Here. Yes. So we are starting working. So units, how many units they are selling? In the first year, it is 300,000. Second year, 410,000. And the third year, 525,000. In the fourth year, it is 220,000. Yes, these are the units. Selling price. Now, focus everyone. Inflated at what is the selling price inflation? 5%. Now focus here. 125. Okay, leave it for the time being. Selling price, do not inflate yet. For your ease. 125, 130, 140, and 120. This is selling price in today's term. So inflated selling price per unit. Yes. Just see here, 120 into 1.05 inflation rate raised to power 1. Here it is, 131. So 5% is the inflation rate. So selling price for year 1. Now, you see, you click here, you will get all the formula here. That how I calculated this. A student was asking question, what if we do not apply this formula like this? If you calculate it on calculator, and after 125, you just write this, you will not get any mark. You will lose mark. Yes, you will lose mark. So you see here, I will simply drag it. 1.50 raised to power 2, and so on. This is the inflated selling price per unit. These are the units sold. So sales, working 1, we can mention here. So what is the sales? Number of units into selling price per unit. Yes, here you go. Here you go. Students, if anything is not clear, do let me know, please. Any formula, any calculation you want to see. Is it clear? Okay, I will come towards that as well. Don't you worry. Okay. I will explain that as well. Okay. Now, so sales. The next is variable cost per unit. They said it is 71, 71, and 71, and 71. The same. So inflated variable cost per unit. This inflation of variable cost is 3.5%. You see, into 1.035 raised to power this inflation. Here you go. Here you go. This is the variable cost per unit. So variable cost working 2 Now, number of units into variable cost per unit. Number of units into variable cost per unit. Yes. Next, let us proceed further. Fixed cost, very easy to inflate. Again, inflated at, what is the rate? 6% per year. Working 3. It is 3,000? No. 3,000? No, it is 3 million. You see, 3 round off. So it is, be careful. 3 million into 1.06. Okay, leave it. For the time being, let me write the same way. To avoid confusion, fixed cost, leave it. 3,000, then is 3,100, 3,200, then it's again 3,000. So inflated fixed cost at 6% equal to this. Oh my goodness. We will write 3-digit more. 1, 2, 3. 1, 2, 3. Yes. This into 1.06 raised to power this. So inflated fixed cost. Inflated fixed cost. Next. So inflated fixed cost is done. Any other working? The other working is tax allowable depreciation. Yeah. This is the working 3, by the way. The next is tax allowable depreciation. Tax saving on capital allowance. Which is what we have to calculate. Working 4. Now, student, you have to present this working like this to attain the marks. So you see here, year 1, 2, 3, 4. WDV, they say 20 million is investment. This is the investment. 25% reducing balance basis you can calculate. So capital allowance can be claimed at 25%. Sorry. Yes. So capital allowance, WDV, this minus this. Yes. So capital allowance, this into 25%. This minus this. This into 25%. Zero residual value at the end. It was in the final year, the full amount will be charged. What I have done, I have calculated this. You see here, In the final year, the full amount will be charged, capital allowance. Now, tax saving at the rate of 26%. In the same year, you see here, so you tax saving in the same year, this into 26%. This is the tax saving. Student, any calculation you want me to re-explain, please ask. Tell me, is it clear? Good. Now, so this working is done. Anything else here? Nothing. Right. So come here. So this is what we needed. So come here. Yes. Here 0, 1, 2, 3, and 4. Sales of the project. We will link it working 1. Less variable cost minus variable cost. Less fixed cost minus fixed cost. Now, so taxable cash flows. Yes. Tax is at 26% tax expense or tax payment. So you see here, these are the taxable cash flows. Tax expense is equal to minus sign shows it is payment, 26% into this. Tax expenses here. Now, post-tax cash flows. This plus this. Yes. These are the post-tax cash flows. Then is initial investment. Initial investment is 20 million, negative 20 million. And scrap value in the final year, 0, no scrap value. Tax saving on capital allowance. Yes, I will link it here. Linking of cells. That is important. So we have linked the cells. Now, next. So, students, The next is net cash flows. Net cash flows. Net cash flows. Yes. From here is equal to sum from here to net cash flows. Yes. Net cash flows. Now, students, discount rate, nominal rate, 12%. So present value at 12%. You see here, equal to this into 1.12 raised to power minus this. Simple is that. Present value at this, and NPV is equal to sum of all. This is the NPV of the project in front of you people. This is the NPV of the project. Yes. Any point you want me to re-explain? Why the power for? Yes, a good question. Because it is discount factor. If you remember the formula, a basic thing it is. Let me explain. I'm happy you have asked the question. Present value is equal to future value into 1 to plus r raised to power minus n. Basically, this is discount rate, discount factor. We are calculating present value from the future value to now. For when we are inflating, there we do not do negative. Inflating means we are calculating future value. Then we are applying this formula, present value into 1 plus r raised to power n. In this case, we are calculating future value when we inflate cash flows. We apply this. Okay, dear, is it clear? This is discount. Welcome. Now, let us proceed further. So this was the A part, by the way. It was the first part. Ping company is first part. Nominal calculation of nominal NPV of project. Yes, second part we will be doing. Second part here below, calculation of real NPV of the project. Real NPV of the project. Calculation of real NPV of the project. Now, for that purpose, the same project, what we will do, nominal pre-tax or taxable cash flows of project we need. We need that. Here 0, 1, 2, 3, and 4. You see here. Nominal cash flows we will pick from here, taxable cash flows. We will discount them. We will discount them and calculate real, yes, real cash flows, real taxable cash flows. How we will calculate? We will discount them at general inflation rate. And general rate is this, 3.7%. 1.037 raised to minus discount. Discount. Simple is that. Yes. Real taxable cash flows. Now tax will be paid on it. Tax payment. 26%. This into, sorry, negative first. 26% into this. Tax payment is here. Now, investment, that is equal to 20 million, negative 20 million. And tax saving on capital allowance, it will be the same, which we calculated above. Nothing will be different. Only one difference. We convert taxable cash flows into real cash flows first. Here. Now, net cash flows, real cash flows, in other words. So equal to sum from this to this. Real cash flows, net. Now, real after tax cost of capital is 8%. So present value at 8%. This into 1.08 raised to power minus this. So we will do this calculation here. So NPV is equal to sum from here to here. This is the NPV calculated, real. So 337 here. And what was the NPV here? 333 here. Small difference. Why is the difference? The difference is, yes. So real NPV and nominal NPV have a small difference. Have, my God, it's not charging. Why? A small difference. No, it's okay. Difference. As same tax allowable, same tax saving has been used in both methods, but discount rate is different. So as per the NPVs of both methods, NPVs through both methods, for the project are positive. So the project should be accepted. Now, comment. They said comment on your finding too. We have commented. We have commented. How are the marks allocated? Good question. The marks allocation. Students, this final comment has normally 1 to 2 marks maximum when they say calculate and comment in this question. Okay, normally 1 mark is there, maximum 2. Okay, now marks are allocated per step. Per step marks are there. For example, selling price. Let me open the marking scheme in front of you. Just a minute. Let me download it in front of you. Marking scheme is basically, it is per steps mark. Per step marks are allocated. Yes. I'm opening that. Yes, just see here. Sales. Calculation nominal 1 mark. Variable cost 1 mark. Fixed cost, tax payable 1 mark. Tax allowable benefits. Capital allowance has, capital allowance calculation, tax saving, they have 2 marks. First of all, you will calculate capital allowance, get 1 mark. Tax saving, 1 mark. Text timing, correct using. So 3 marks are for text adjustment. You see here. Present value and nominal value, 1 mark. Okay, NPV. Real cash flows, 1 mark, one comment has 1 mark. 1 mark is for the comment. Is that okay? Clear how the marks are allocated? Is that clear? Yes. So Tabriz, you didn't respond. The marks allocation is clear? Okay, now, thank you. Right. So let us proceed further. Let us proceed further. So 4 ways to encourage. Discuss. See, they said discuss. Discuss means paragraphic form. 4 ways to encourage managers to achieve stakeholders' objective. 8 marks. Oh my God. And students don't usually ignore it. So the first way to managers, yes. So managers can be encouraged through number of ways as follows: to achieve stakeholders' objectives. I will give 4 headings. One is performance related pay. Second is share option scheme. Yes, share option scheme. Then is executive, no, shares, offering shares as part of remuneration. These are 2 different. Share option is different and this is different. And then, yes. So, corporate governance best practices. Yes. Now, I will explain one by one all. Performance related pay. Students, what is it? So, students, the managers, part of salary, that should be based on achievement of certain targets. They have means that they will achieve a growth in earning per share. For example, growth in share price, and then they will get performance related pay. Or They will improve environmental impact of the company. So hence, in order to get performance related pay, they have to achieve these objectives of organization. Next, second point, the share option. Share option can be offered to the managers that they will be entitled to purchase company's shares company's shares at certain price in the future. In the future. So, in order to make their share option valuable for them, managers will try to implement the policy which can increase share price. Hence, it will lead to shareholders' wealth maximization. It will lead to shareholders' wealth maximization. Now, next. Now, offering shares as a part of remuneration. Now, so offering shares as a part of remuneration. What is it? So hence, managers can be offered can be given shares of the company as a part of their salary package. Hence, They will be behave like owners of company. Now, so they will be owners and will be thinking like the owners and will be taking decisions in the best interest of shareholders. Now, next one. The next is corporate governance best practices. Corporate governance best practices have been developed to encourage managers to achieve stakeholders' objectives. They are related to board of directors' responsibility, accountability, remuneration packages, audit, and internal controls. To ensure directors act in the best interest of shareholders. Done. So this question is wind up. I will take a short break of 7 minutes. Okay, 7 minutes break. I will take. I will be back and I will continue with some next topic. Maybe capital rationing, maybe risk and uncertainty. We have to do the both. And then, of course, practice questions as well. So 7 minutes break, short break, refresh yourself and be back. Thank you. Yes, everyone. Now, students, the next topic is capital rationing. So what is capital rationing? Capital rationing is when the company has limited funding available. Funds available, they are limited for investment. That is called capital rationing. Means that the projects available for investment are so many projects available, but the company have limited funds. It is similarly that I have limited money, but I have so many ambitions. It happens, you know that. So that is called, this situation is called capital rationing. That available funds, they are limited. Now, this availability of limited funds availability, it can be because of multiple factors, reasons of capital rationing. What are the reasons of capital rationing? Causes. One is called internal factors and external factors. So internal means self-imposed. Capital rationing. People want to give funds to us. They want to invest in the shares. They want to give us loan, but we are not. We say, no, sorry. We will be only limited capability of management, or management are careful in the growth step by step, or company does not want to issue shares because current shareholders say we will lose controls. We cannot issue. Yes. Hard capital rationing are because of the external factors. Companies want to issue shares, but market is not responding. Company wants to raise loan, but loans are not available. External factors. Okay, that is called hard capital rationing. Now, the point is, the capital rationing can be single period. It can be multi-period. These are the causes or sources. These are the sources of capital rationing. Sources, capital rationing. And the next is single period capital rationing and multi-period capital rationing. Yes. So single period capital rationing, when funds are limited for one financial year only. Limitation of fund is for 1 year only. Single period. Multi-period, when funds are limited for multiple years, number of years. Single period and multi-period capital rationing. Now, the point is, basically, the company wants to maximize what is the company purpose? To maximize NPV. Limited funds within available funds. This is the purpose. This is the objective. So if it is a multi-period, funds are limited. So then how to, there are so many positive NPV projects available. So which project should be chosen? In case of multi-period capital rationing, Optimum investment plan is chosen through linear programming. Optimum means best investment plan, which is best investment plan, the best, which is giving the maximum. Then best means here. In case of, but if it is the single period capital rationing, and we have to choose optimum investment plan, its calculation are part of our syllabus. Now, two cases may be there. Available projects are divisible. Available projects are divisible. And the second case is they are indivisible. Divisible and indivisible. If available projects are divisible means that you can take part of the project. You need not to invest in full. Then it is called divisible. Indivisible means that you have to either take full project or leave it, take it or leave it. If projects are divisible, we calculate NPV of each project. Profitability index. How profitability index is calculated is equal to NPV of the project divided by initial investment. This is called profitability index of the project. Then we rank projects as per profitability indices. Profitability indices. Yes. Highest profitability index ranking 1, then lower 2, then lower 3, and so on. Then investment plan is made. Now, not if projects are indivisible, we make possible combinations. Possible combinations within investment constraint. Each combination is made that we will invest in this combination and see which has the better NPV, which combination, and we accept the project. Now let us try to solve some question instead of talking about example. Let us talk about some question. The question is on the capital rationing. Croquette. September, December 2020. Croquette company. September, December 2020. Just a minute. September, December 2020. Past paper. If it is calculation, let me check it, please. Just 1 minute, please. Yes, it is a good question. Here we are. Let me share it with you people. This is the question. The scenario investment decision, right? 6 investment projects are being considered. Initial investment, Crockett, and NPV. This project B details are given. Project B's cash flows are here in front of us. It is September, December 2020 past paper. Now, so cost of capital, nominal cost of capital, 10%. Due to management's reluctance to raise new finance, capital for investment in the above product is currently restricted to this. A, B, D, and F are all. C and E are mutually exclusive. Very good. I am happy this investment is there. I will explain it. All of them are divisible and none can delayed or repeated. Investment is seen too. Okay, it is about another part. Okay, now, so what is the requirement? Come here. Calculate NPV of project B. Given the capital constraint, calculate the optimum investment combination and the resulting NPV. Very good. Very nice. Right? Now we will be solving it. A part and B part is here. Replacement cycle. We have to do this topic yet. Okay, come here. Now, so first of all, NPV of project B. We will be calculating this one. NPV of project B. Yes. Here we are. So what I'll be doing, yes, Crockett. This Excel sheet I will be sharing with you at the end of class in the WhatsApp group. Okay, I'll be sharing it with you. Crockett Company, this Excel sheet. Now, so yes, here we are. So they say that, oh my God, cash flows, sales given and cost given, 4% for the sales and 5% for the cost. Nominal cost of capital of this. Very easy to calculate NPV. Yes, very easy to calculate NPV. Sales and costs are given, no taxation, nothing like that. Okay, nothing is problematic here. Investment is here, 1.5 million. So very easy. Project B NPV. We need to calculate. We get 0, 1, 2, 3, and 4. Sales. That is, oh, we have to sales inflated at the rate of 4%. Okay, 725,000. Okay, 725,000. It's your choice. You can do working even. Okay, you don't want to do it here. You can do working here below. Working. Sales. Year 1 sales is 725,000, then is 765,000, then is 885,000, then 612,000. Now inflated at 4% per year. Yes. So year 1, 2, 3, and 4. Now, you see here, this into 1.04 raised to power. Here you go. Yes. It is here in front of you people. Now, the next is cost. Given cost is 145,000, 168,000, 202,000, 94,000. Now, so inflated at, what is the inflation? 5% per annum. Okay, 5% per annum. This into 1.05 raised to power this. Here you go. This is the cost. So sales. This is the sales. Less cost minus this. So net cash flows. These are free marks available in the past paper question. If a student cannot score these marks, now NPV, sorry, present value at the rate of, what is the rate given? 10%. Sorry. Yes, at the rate of 10%. So equal to this into 1.1 raised to power minus this. So NPV is equal to sum. I'm sorry. Here we have not mentioned initial investment. Okay, NPV is equal to this plus this plus this plus this cash inflows minus initial investment 1.5 million. Right? 1 point initial outlay. Okay, 1.5 million. This is the answer, NPV. This is NPV. Next. The next point is, so the first part is done. Now we have this. So we have to choose optimum investment plan by considering projects are divisible 6 marks and the resulting NPV as well. Now come here. So we will be talking about it. Yes. So here it is, second part. Yes. So project, initial investment, and NPV. So they are 000 round off, 000 round off. Good. So project A, 1,390. B, 1,500, and we have calculated its NPV above 561. 3 round off 561. Next, C, 750 325. D, divisible project. Remember, projects are, it is choosing optimum investment plan if projects are divisible. Projects are divisible, it is the requirement. So D, 1125, and the next is 590. E, in exam, you can copy and paste here, simply. E, 1850. Exam platform, you can copy and paste. 840. And F, 1300 and 635. Projects are divisible. Initial investment. So what we need to do, we need to calculate profitability index. Profitability index, NPV divided by this. Profitability index is calculated. Then is ranking. The first ranking, second ranking, third ranking, fourth ranking, fifth ranking, and sixth. Highest profitability index, then, and so on. Available investment is available investment is 5 million. C and E are mutually exclusive. Available investment is 5 million. Okay. C and E are mutually exclusive. Okay. Now we have to choose the optimum investment plan. Just see here. Focus, everyone. So it is available investment. Okay. NPV. So initially 5 million. Focus, everyone. The first choice is the highest, D. So project. Required investment. Yes. Project. So project is the first of all, D. Available. So investment will be there. Equal to minus, you see here, should be deducted how much? 11,25,000. Sorry, 11,25,000. This is the investment. And NPV earned will be 590. 590, 1, 2, 3. So remaining investment will be this. Remaining. The next is the turnoff. Ranking 2, F. And required investment is minus 1,300, 1, 2, 3. And 635,000. 635,000. Next. Third, this is C and E are mutually exclusive. Means that C and E, we can take one of these. We cannot take these both. So which one is better? E, because it has a high profitability index. Because it has, now it is remaining investment, high profitability. We will choose E, high ranking. So project E. Investment required in the E is 1850. 1, 2, 3. And NPV is 840. Yes, here it is. So remaining investment is this plus this. Yes. Next. So students, the next point is, so we have chosen D, F, and E. Now available funds are this. We cannot invest in C. We cannot. We have to leave it. Fifth number, A. A. How much we can invest? 725,000. Because projects are divisible. We can invest 725,000. How much investment is there? 1 million. So we invested how much percentage? 725,000. We invested. Total investment required is this. This is the percentage investment. We invested this. Total investment is 1 million. Multiplied by, what is NPV? Same percentage of NPV, 390,000. $725,000, 1 million, 390,000. Yes. It is here in front of you. We have 725,000. How much investment required? 1 million. So 725,000 divided by 1 million. Percentage investment. Same percentage of NPV will be earned. Same percentage of NPV will be earned. Yes. So NPV earned. Total NPV earned is here. Yeah. So what to be written? The optimum investment plan is to invest in projects D, F, and E in full, and partially in project A. And total NPV earned will be, to be earned will be 234,775. Yes, that's it. I hope it is clear to you people. Now, it is done. So the next part. If you come to the question, B part we have not done yet, okay? But there is a C part as well. In relation to investment decision 3, describe two approaches for dealing with inflation and provide a reasoned recommendation which approach they should take. Yes. Reasoned approach. Yes. So students, 6 marks. So two approaches, 2 marks each. Then this method will not be used. Remember. Then profitability index method will not be used. Tabrez. This profitability index method can be used only when projects are divisible. This method will not be used then. Okay. Let me finish this question. Then I will answer your question in detail. Let me complete this question first, which we are doing. Okay. I will respond to your question that how to deal with it. Now, the point is, describe the two approaches for dealing with inflation. 2 marks each. What is the nominal approach? What is the real approach? So real approach does not consider inflation. So therefore, cash flows will be used real cash flows, and these net cash flows will be discounted at real cost of capital to calculate NPV. This is a real approach. 2 marks. What is nominal approach? The next will be the heading nominal approach. So all the cash flows will be inflated to get net nominal cash flows. That is sales, costs, and other cash flows will be inflated using specific inflations. And then nominal discount rate of company will be used to calculate its present value and hence NPV. Now, the next is choice of approach. What will be the choice of approach? The third is reasoned recommendation. Now we need to check what they are saying in the third part. Come here. Here is the whole story given in the scenario. Yes. They're considering financial viability, but no financial available before NPV. One of the various cash flow will be subject of different rates, which are very uncertain. For example, if we will be selling inflation may be no more than 2%, while material could be inflated to 4 to 6%. The general rate of inflation is expected to differ from both of these. Which one will be used? Now, what is the so choice of approach? Students, since there is not a single rate for cash flows of the company, of the project, and it is different than general inflation. And there is a high uncertainty regarding inflation rates in the future. So using the real approach, by the Crockett Company to appraise this project will be unsuitable. will be unsuitable. As real method will not consider the difference in general inflation and specific inflations. General inflation and specific inflations. Hence, a nominal approach will be suitable for it. So 2 marks each. It is done. Next. Students, capital rationing. The question was that if projects are not divisible, then what to be done? You come here. Let me show you. This is the projects and NPVs, investment and NPVs. Okay, available funds are here. So this method we have considered already, that if they are divisible, we calculate profitability index and ranking and then select. Okay, but if projects are indivisible, then we make combination of the project. Available funds are here. This is the constraint. So we make combinations A plus B. Total investment is A and B. Yes. By the way, 1800. Okay, here, sorry, here they are. Investment is here. 1200 and 1000 here. 2200. And NPVs of these two. This is a combination. Then A, C, and D within constraint 2500. A, C, and D. So the sum of these three is 2500. Their NPVs. So you see here, this total should be less than 2500. And the relevant combination should be made within like this. The total is less than 2500 available funds. And their NPVs are totaled. So the best combination is that which is giving a highest NPV, ACD. When projects are indivisible, they are solved like this. Is that clear to you people? Tell me, please. Is that clear? Yes, Tabriz, you asked for this. Tabriz asked for this. Okay, right. Let us proceed further. So students, asset replacement decision. that the company wants to how to replace a non-current asset, plant and machinery. Company wants, because asset has cost, maintenance cost, replacement. They have to replace and buy new assets. And if they don't replace, they will be, they have to maintain. Its maintenance cost increase year by year. So the approach is that we should use, so how often they should replace the asset? 3 years, 4 years, 5 years? How often the asset should be replaced? So the option which has the minimum annual equivalent cost, we calculate the EAC for available options. For example, 3-year replacement or 4-year replacement. NPV of cost of 3 years divided by annuity factor for the 3 years. Then NPV of the cost for the 4-year replacement divided by annuity factor for 4 years. And choose with option with the lower equivalent annual cost. That is chosen. And then is, yes, we will be doing the question on it, don't you worry. Lease or buy option. Lease or buy option. Now, company has made the investment decision. Okay, investment decision. So should the asset be leased or bought? It should lease the asset or buy it. What they should do? Yes. Lease or buy. Decision has to be made. So students, the point is, it is financing. So we pick only relevant cash flows, relevant financing cash flows only. Investment should be made or not, that has already been done. Now we are making financing decision. Yes. So here it is. Here is the financing decision. Has to be made. Investment decision already done. Through NPV of the project or IRR of the project, whatever it is. Now financing, whether it should be financed through bank loan, go buy bank loan and buy asset, or through lease. So if we lease, we have to pay lease rentals, then tax relief on rentals and net cash flows. Their present value to be calculated by discounted at post-tax cost of debt. I repeat, post-tax cost of debt. Only here, because it is lease or buy financing decision. If we buy assets, then initial investment will be there. Okay. Written down value. Then one thing which is missing here. Yes. WDV. Yes. Cost of investment. Sorry. Just a minute, please. Just a minute, please. Yes. Cost of investment. Tax relief on yes, written down value. Means tax saving on capital allowance. I will replace this word. Tax saving on capital allowance will be there. And the next is lease residual value. Net cash flows are calculated in this case, and they are discounted at this. So hence, whichever option has less negative NPV, because they're financing cash flows, we choose that option. Whichever option has less. Now, let us go to the past paper and try to solve a question on it. A Milane is a wonderful question. Okay, March, June 2020, equivalent annual cost. So we have done this in class. Okay, Crockett, we have done it in class. Okay, and we are doing it now, 3, and then we will be doing another question today. So 4 questions. I'll be winding up investment appraisal and section C today. Then you will have 1 full week to revise theory from notes, these notes, book, doing practice section C. In the next class, next week, if I show you my plan, this is as per my plan, what is happening. If I show you my plan, investment appraisal will also be done in the next class. This is basically OTQs. Section A and B practice. And it will be done around minimum 2 hours, 2 to 2.5 hours. Practice we have to do in the next class. Okay? But for that purpose, you need to revise the whole investment appraisal theory. One thing, do the section C type question a lot on it. If you want to pass paper F9 in December exam, this is the time for you. I'm telling you. Okay, you can do it now. You have 1 month. Means these 4 weeks. You can do it. I'm telling you. Next. So come here. So we are talking about, yes, this question. Cabrera, okay, equivalent annual cost and investment appraisal to be done in class. March, June 2021. Here we are, March, June 2021. This one. Yes. This is the question. March, June 2021. The requirement is here. Calculate equivalent annual cost 3-year and 4-year interval for the Beast and advise Cabrera's company which replacement interval to adopt. 11 marks. Okay. What is the second part? No second part? Okay, below. Discuss why replacement interval, wow, should be based upon equivalent annual cost. Now they have, discuss why discounted cash flow methods are considered superior to non-discounted. You see here, out of 20 marks, these straight 9 marks are for discussion. And even 1 mark is here as well, minimum. So 10 marks. And very good question, a very good question. Please take time, go through it, be quick. Go through it. Read the requirements once again and go through it. Be quick, please. Yes, please. Now, the next, you have gone through the question. I hope you have gone through the question. So, students, equivalent annual cost we need to calculate. So, Cabrera, C company. Yes. So, company. Right. Cabrera company. Let me close other past papers, which we have done already. Yes. No. Yes. Here we go. So it uses a large earth-moving vehicle construction called the beast to prepare foundation for building. It needs to decide whether the cheapest replacement interval for the beast is 3 or 4 years. Details are as under. Cabrera company purchases the beast from a manufacturer for $800,000, payable 1 year after delivery. Its resale value will fall by 40% of the purchase price at the end of its first year of operations. The resale value will then reduce by 25% for further year of operations. Okay, and every maintenance cost of 20,000 first year, rising by 5%. Maintenance must be provided in the year of sale. If the beast is operated beyond 3 years, it is subject to government safety and carbon emission test. The test would be paid for and taken place at the beginning of year 4. Correction of any fault discovered by this test is mandatory. It is 80% chance that test and remedial work could cost 50,000 and 20% chance that it will cost 120,000. Cost of coverage is 8%. Wow, it is wonderful. By the way, wonderful question it is. Now, students, 3-year replacement cycle. First of all, three-year replacement cycle. Here is 0, 1, 2, and 3. They say that 800,000 is the cost, which is payable 1 year after delivery. Now, this is basically the technicality they have charged to it. If you purchase today, they deliver today, but payment have to be made in year 1. So purchase cost, that will be 800,000, like this. Then they said maintenance cost is 20,000 at the end of first year, and then increasing by 5%. So maintenance cost 20,000 here. Okay, then increasing by 5%. Sorry, 5%, and similarly 5% increase then as well. Increasing by 5% every year. Then yearly fuel cost is 28,000 in the first year, then 5,000 increase every year. Okay, so fuel cost. So in the first year, 28,000, then increase this, it will be 33,000, increasing by 5,000 every year. Yes. Resale value, residual value. They say that this is for this we were have to do working residual value. So year 1, 2, 3. So 0. So residual value is, they say 1 year use. 40% at the end of the first year of operation will fall by 40%. It means it will be 60% of 800,000. Fall by 40% now. Then it will decrease by 25% per year. So it means it will be next year 75% of it. 75% of it. And next year again 75% of it. So 270,000. It will be 270,000. So residual value will be here. Okay. This is clear to you, everyone, up till now? Is it clear so far? Any calculation you want me to show again and explain so far? Please ask. Now, next. The next point is, one person responded. What about others? Is it clear, students? Tell me, any question, anything you want me to re-explain? So, net cash flows. Sum from here to here. NPV of cash flows means, in other words, present value of cash flow. Cost of capital is 8%. This into 1.08 raised to power minus this. Yes. NPV of cash flows. Okay. Now, so NPV of cash flows, sum, by the way, put it present value of cash flows. Yes. Now NPV of cash flows is here. Now, so equivalent annual cost for replacing 3 years, this divided by now 3-year annuity factor. It will be provided to you in the exam platform. Remember that. It will be available in the exam platform. So just a minute, please. Formulas. sheets. Just 1 minute, please. I need to check the annuity table. Yes. Math, it should be. Yes. It will be. Yes. This will be provided to you in exam. So annuity 8% for 3 years. 2.577. 2.577. This is called equivalent annual cost of replacing machinery every 3 years. Yes. Every 3 years. Okay. So 4-year replacement cycle. 4-year replacement cycle. Year 0, 1, 2, 3, and 4. Student, remember one thing. If you will not be attending live classes, I will lose interest. Means that, for example, in the next class, you say, okay, Mr. Hamzah will provide the video recording as well. So why to attend live class? It will be the first step and first blunder and first right step to fail your paper. Because then you will not be preparing for exam, I'm telling you. Attending the crash course and not following the instruction is a perfect recipe for failure. I'm telling you, after crash course, you have to work hard during the full week. But some of you people, when I told them that this is practice question, means they are not taking it serious. They say, okay, we will cover the video. I received messages from the student. But remember, video, 3-4 days you sit and watch videos. At what time you will do practice? So please follow the plan, which I'm telling you. If you want to avoid failure, if you want to increase chances of getting passed, so don't fall prey to the procrastination that I will do. Now I am getting bored. Okay, leave it. I am tired, I am very much tired. Self-pity. I'm sorry to say. This is what students do for failure. Now, 4-year replacements. So in the 4-year replacement plan, the cash flows are, you see here, cash flows are same. Yes. Three are the same. And yes, maintenance cost will be this. It will be in the 4-year as well. Sorry. No, this is blender I'm doing. I'm just showing you. We need to show working. This into 1.05. You cannot copy paste like this, the way I did before. We need to show the working so that when examiner click on it, they should know where it came from. You cannot do otherwise copy paste. Yes, you can link cells because through that you can find out that connection. Now, so fuel cost increasing 5,000. Yes, we know that 28 and minus 43,000. Yes. Then will be, they say that safety cost 80% chance that it will be beginning of year 4. It means that is 80% will be chance that, and 20% chance that the cost will be this. It has to be paid at the beginning of year 4. It means it has to be in year 3. So working. So safety test cost. %80 chance that that will be 50,000 plus 20% chance that it will be 120,000. Yes. So 20% chance that it will be, you see here. Yes, you can do. But formula, yes, it should show the formulas, the calculation. Okay. Examiner should, but you know that examiner should able to verify how you have reached it. The purpose is that. Got it? Now, here you go. Safety test cost. So safety cost. Why in year 3? Because they say it has to be paid in the start of year 4 minus this safety test cost. Then is the resale value, residual value at end of year 4. And we know that it is decreasing by 25% per year. Now, another working residual value. Here is 0, 1, 2, 3, and 4 equal to just linking it. Okay. Now, equal to this into 75%. So residual value is this in year 4. I will simply shift the working a bit below. Yes. Now, so present value at the rate of 8%. Sorry, net cash flows, first of all. Net cash flows. Here we are. So present value at the rate of 8% equal to this into 1.08 raised to power minus this. This is the present value. And NPV will be here. Sorry, present value of cost, NPV of cost. NPV of cost equal to sum from here. What happened? Is equal to sum Why I'm unable to pick it from it? Yes. Yes, this is NPV of cost. So equivalent annual cost. Now we need NOT factor at 8% for 4 years. NOT factor at 8%, 3.312. 3.312. This is called equivalent annual cost of replacing every 4 years. Now, so students, now how to draft answer? The 4-year replacement cycle has lower equivalent annual cost. Lower and yes. So the beast, the machinery, it is machine, should be replaced every 4 years. Yes. What is that? What is how many? Yes, every 4 years. But yet there is the problem. There is a problem. What is the problem? The problem is that advice. The problem is that students, the testing cost, the safety testing cost. Yes. This is the safety test. There is 20% chance that safety test will cost 120,000, and if it happens, then what will happen? Then 3-year replacement option may be a better choice. Yes, in that case, 3-year replacement. That's it. Yes, of course. Of course, you're right. Now, the second part. Why replacement interval decision should be based upon equivalent annual costs. Now, students, note down this answer, please. Why replacement decision should be based on equivalent? Why we are not comparing two options? So, friends, when a project has to be repeated, when a project has to be repeated, again and again, and the machinery to be used need to be replaced. Need to be replaced. So, whether it is to be replaced over 3 years or 4 years, whether it is to be replaced over 3 years or 4 years, NPVs of the both options are not comparable. Are not comparable due to different length of time. So in order to account that, in order to account for that, NPVs of both options are divided by the annuity factor as per the replacement option. That is 3-year annuity factor for 3-year replacement and 4-year annuity factor for 4-year replacement. And the resultant amount is equivalent annual cost. Equivalent annual cost, which is effective annual cost of each option. It is effective annual cost of each replacement option. So E equivalent annual cost compares the effective annual cost of different replacement options. Now, now, next. So, student, this is how it is done. Why discounted cash flows are considered superior to non-discounted cash flows? Why discounted cash flows are considered methods? Now, student, this is such a basic question, such a basic. Student, discounted cash flow methods. Consider time value of money. Time value of money. That is, today's amount received is having more worth than to be received tomorrow. To be received tomorrow. Secondly, discounted cash flow methods are normally based on cash flows which are more reliable than the profits such as NPV and IRR. Utilize cash flow. While IRR is accounting profit based. And it is and ARR, ARR is profit based. I'm sorry. Accounting rate of return is profit based, which can be manipulated. Now, payback is a non-discounting cash flow method and does not consider full life of the project. While NPV and IRR both consider full life of the project. Both consider full life of the project. Next. IRR and NPV has clear-cut decision rule. Has clear-cut decision rule. That is, NPV is positive, accept the project. And IRR is greater than cost of capital, accept the project. While ARR decision rule is not that much clear. It is decided by the management. Yes. You see how easy it was. How easy it was. Now, so it is done. So student, let us proceed further. Yes. We have one topic left, sensitivity analysis. I am not doing it today because I feel like majority of you are tired. I will do a question on lease and buy, and I will wind up today's session. In the next session, I will start with sensitivity analysis and a question on that. So lease or buy decision. Come to the question. Yes. Lease or buy. So it is done as well in class. Yes. So we are doing it. Habak. Okay. These are NPV question. I will be doing. Yes, this is lease or buy. Ding company. September, December, no. So I'll be opening this September, December 19. Here we go. Now, Ding company. Here it is, September, December 19. Lease or buy. Present value of cost of borrowing to buy. Present value of leasing, and recommend which option is more attractive. You see here, discuss why capital may be rationed. Soft capital rationing and hard. In these smart notes, I have not done in detail. Here you have to give example to score 6 marks. 3 marks for soft capital rationing. You write 3-4 points and the sources examples. and hard capital rationing. We discuss the ways in which capital rationing may be overcome, which they are facing. Again, methods to overcome capital rationing. Soft capital rationing and hard, they are given in all the books. You will simply link it to the scenario. So you see here, 10 marks, 50%. And students, if you are unable to write this answer, these answers straightforward, no, what can I say then? Okay, so come to this scenario. Big company. Last question for today. Read it please once. Be quick. Now, so be quick. Tell me, have you gone through it? All right, good. So let us solve it. Big company. So cost of buying the machine, then cost of leasing the machine. Yes, they said that. Present value of the cost. Yes. So let us solve it. Tax allowable. Tax allowable means it is, yes, you can deduct it against the profits. Tax saving will be on it. Okay. Not tax allowable means that due to it, you will have tax saving. Okay. Your taxable profit will reduce by this. Hence, tax saving will be there. Tax allowable means tax authorities allow this cost to charge against taxable profit. Hence, taxable profit will reduce by this, and you will have tax saving. Got that? The question is, what is tax allowable? Tax exempt? Now, so the next question is, so today is big company. It is fourth question for today. And we are doing a wonderful job. I'm happy. I'm satisfied. Yes, that we are moving as per plan, what I thought. Okay, what happened? Okay. The question is Dink company. Now, so the buy option, A part is buy present value of cost for buy option, the first part. You see that the small company initial cost is 750,000, 4-year loan. This interest before tax interest rate. The machine would have an expected life of 4 years. At the end, the machine will have residual value of this. Tax allowable servicing cost for the machine will be this. Tax allowable depreciation will be available on a 25% reducing balance basis. Okay. Tax is payable in areas. So this is the information. Okay. What is the maintenance cost? Okay, right. Good. So the life is easy. Come here. So 4-year life. You're 0, 1, 2, 3, and 4. So you see here, maintenance cost. Sorry, initial cost of machinery. Machine has a cost of 750,000. Then it is residual value is 50,000. Tax allowable servicing cost. Servicing cost 23,000. Focus everyone. 23,000 every year. I'm sorry. Sorry. Yes. So this is a servicing cost every year. Now it is tax allowable. There will be tax saving on it. So tax saving on servicing cost. Tax is 30% in area. So 23,000 into 30%. It will be the tax saving. This is for year 1. And then this will be, because since it's the same. Yes. It is the same. Tax saving on in areas. For year 4, it will be in year 5. For year 1 here. Tax saving on servicing cost. Then we have to calculate working. Yes. That is tax saving on capital allowance. We have to do this working. So year 1, 2, 3, and 4. So WDV 50,000. 25% reducing balance basis. So capital allowance will be equal to this into 25%. Now, WDV, this minus this. This into 25%. This minus this. This into 25%. This minus this. Now, what is the residual value? 50,000. So the final year it will be this minus 50,000. This is the capital allowance you see here in front of you people. So now tax saving 30% in arrears. Year 5 will be there. You see here, this into 30% and so on. Tax saving on capital allowance. Yes. So we will simply put it here. Allowance. I will simply link the cells. Here we go. Yes. Is it clear so far? Is it clear? Anyone, any question? Right. Now, so the next point is, students, net cash flows. Sum from here to here. So this is NPV of buying the machine. If we buy, only financing cash flows. Yes. Oh my God, my mistake. Just a minute. What mistake I have done? Tell me. It is an indication that I should end the class now. I have not discounted post-tax cost of debt. 8.6% it is here. So we need to calculate post-tax cost of debt. Working. Post-tax cost of debt. Yes. That is equal to 8.6% pre-tax into 1 minus tax rate. Pre-tax cost of debt into 1 minus tax rate. It is here. Post-tax cost of debt. Pre-tax is 8.6. So present value at the rate of 6% equal to this into 1.06 raised to power minus this. So NPV is equal to sum from here to here. So this is NPV of buying the machine. Oh, 1 year is missing. I think year 5 is not included here. Yes. Okay, just a minute. Yes, just a minute, please. G, no, it is H11. Yes. Students, just a minute, please. Just 1 minute, please. What I will be doing, just a minute, please. Straight away factor that we should in class. I'm sorry. Residual value I have missed. That is 50,000 here. Now is equal to sum from here to here. Now it's good. Residual value. Residual value. Here it is. So this is NPV of buying the machine. Now, so NPV of buying. Now the next option is, it is easy, not tough at all. The other option is, that is the present value of cost of leasing, which is very easy. You just see here. They say the lease option is there. So the second part is present value of cost of leasing. So year 0, 1, 2, 3, and 4. The company has offered a contract whereby Ding company could have use of new machine for 4 years in exchange for annual lease rental payable at the start of each year. Yes. Nothing has to be paid, anything else. Leasing company will remove. They will do everything. Just focus here. Lease rental. How much? 200,000 at the start of each year. So lease rental 200,000 at the start of year 1 mean year 0. Same here. So for your year 4 at the start means the previous year. Now tax saving on lease rental. Now it will create a point. Just see here. Year 5. First time tax will be paid in year 2. Because for profit will be earned here, tax will be paid here. So tax saving will start here into 30%. 30%. In arrears, I repeat my words. So then why tax saving is starting from year 2 and going to 6? For year 5. Because tax has to be paid in arrears. For year 1, tax will be paid in year 2. For year 2, tax will be paid in year 3, and so on. And so tax saving will be in those years. So for this tax saving here, for this tax saving here, and so on. So net cash flows. Sum here. Yes. So present value at the rate of 6%, same discount factor, equal to this into 1.06 raised to power minus this. So present value of leasing of cost, NPV, cost of leasing of leasing equal to sum from here to here. So you see here, leasing cost is here, option is here, and the other option is here. So which option is better? Leasing. Leasing of option is recommended because it is a third part. So financial benefit, third part. Which option is better? Which option is better? So net benefit of leasing option that is equal to 597268 is here cost, and leasing has 538464. So we will simply calculate it here.
This is the net benefit of leasing, 58804. So leasing is a better and cheaper option. Yes. So it should be accepted, should be chosen to finance the machinery. Yes. It is done. It is done. Is it clear, students? Good. So students, that's it for today. Now, what you need to do is, these questions you should revise. So we have done 1, 2, yes, 4 questions in class. Try at home. This try at home. Yes. Done it in the class. Right? So the point is, exam kit you people have. Yes, here is the exam kit, which I've shared with you people. And if you see, there are so many questions on it, on these topics. C-type questions, investment appraisal. Hebek, it is in the notes. Milane is in the notes. Pink, I have done. Dink, I have done. I have done. 266, 267, I have done. This is in the notes. In my opinion, you should at least solve 2015 onwards. Whatever questions are present, 2015, attempts are mentioned here. Onward, all questions you should try. So what I am recommending you, that and solve their theoretical parts as well. 2015 onwards and onwards. Yes. Section C type questions. And if you will do this before next class, remember, then the next section we can work on the OTQs. OTQs, objective test question, I'm saying, section A and B, they test more in-depth knowledge and can be done only when you are having a good hands-on practice, of this section C. So that's it for today. So thank you for joining. We'll be meeting next Wednesday. Till then, take care. Goodbye. Goodbye. Good night as well. Goodbye. Thank you. Thank you.